Gold and silver investors, in the next few hours, we find out how this entire bull market wants to walk into the most dangerous liquidity week of 2026. Asian markets reopen tonight, China shuts down tomorrow for Lunar New Year, and we then trade 8 full days without the world's largest buyer, with a 4-to-1 paper-to-physical setup on COMEX less than 2 weeks from first notice. I'm OG John AG, and in this video, I'm going to show you what Friday's CPI spike really changed, why tonight's Asian Open is the last normal session before the liquidity drain, how China's shutdown turns every headline into a potential landmine, and the 3 scenarios that can play out between now and the February 27th delivery line in the sand. Segment 1, Friday's CPI. Real volatility, not noise. Let's rewind to what just happened. U.S. markets have been shut since Friday 5 p.m. Eastern. The closing marks looked calm. Gold settled around $5,040, up about $80 or 1.64% on the day. Silver closed near $78.90, up about $3.74 or just under 5%. But inside that session, silver didn't move. It whipsawed. Intraday low, $73.98. Intraday high, $79.35. That's a $5.37 range in one session, roughly 7.25% of the entire price. Gold briefly tagged the 5 to 100 area before easing back to the 5 through 40s. That's real volatility driven by a real macro catalyst, not just random noise. At 8:30 a.m. Eastern, CPI hit. Headline inflation, 2.4% year over year versus 2.5% expected, the lowest since May 2025. Core CPI, 2.5%, the lowest since March 2021. The market's reaction was instant. The dollar index dropped. The 10-year Treasury yield fell about 11 basis points. Real yields on tips slipped to around 1.86%. That combination, softer inflation, lower real yields, weaker dollar, is jet fuel for precious metals, and they responded immediately. But here's the crucial point. None of that CPI spike fixed the underlying structural problems in silver. Segment 2, the structural setup, COMEX math, and the ticking clock. Under the surface, the numbers are still brutal. On COMEX, registered silver inventory, the metal with a deliverable tag, sits around 103 million ounces. March open interest represents between 400 and 500 million ounces of paper silver. That's a paper to physical ratio of 4 to 1, possibly 5 to 1 depending on how you count the near month. Inventory is draining at roughly 785,000 ounces per day. At that pace, COMEX bleeds through more than 5 million ounces a week just to keep the lights on. Delivery concentration is extreme. JP Morgan handled about 99% of January deliveries, effectively acting as the main funnel between paper and metal, and the clock is ticking. We're 12 days away from February 27th, first notice day for March silver. On that day, any long holder can say, I don't want cash, I want bars. So as we head into this Lunar New Year blackout, the situation is 103 M ounces registered, 400-500 ounces of potential delivery claims, daily draw of 785K ounces, one bank controlling almost all deliveries. Friday's rally proved one thing, macro still works, but it did not change the inventory math. Segment 3, why tonight's Asian Open is different. Normally, a Sunday, 6 p.m. Eastern Asian Open is just the start of another week. Shanghai, Tokyo, Singapore, Hong Kong, everyone logs back in. Tonight is different because of tomorrow. Tomorrow morning, Chinese markets close for Lunar New Year and don't reopen until Tuesday, February 24th. That's 8 full trading days without China. China is not just another market. Number 1 gold mining nation, number 1 gold importer, number 1 gold consumer, very likely the number 1 central bank gold buyer. The People's Bank of China has bought gold for 15 consecutive months, adding around 40,000 ounces in January alone. Controls roughly 60-70% of global refined silver output, accounts for about 50% of Asian silver demand. When Chinese markets go offline, gold and silver lose, their largest physical buyer, their most active speculative trading venue. That creates 3 big problems: thin order books, fewer bids and offers, wider spreads, lower liquidity, gap risk. Any news, FOMC comments, geopolitical shocks, surprise data can push prices 2-5% on tiny volume. Offshore price discovery Hong Kong becomes the main Asian venue, but it's only shut 3 days, not 8. It cannot fully replace Shanghai's depth and size. We've already seen what thin Asian liquidity can do. On January 30th, 2026, during a fragile Asian session, silver suffered the worst single-day decline in its history, down about 35% in hours as Chinese traders faced margin calls without deep liquidity to absorb selling. The same mechanics can work in both directions this Lunar New Year, selling into thin markets, crash, buying into thin markets, spike. There is no middle ground when liquidity evaporates. Tonight's Asian Open at 6 p.m. Eastern is therefore the last normal session before that liquidity drain. One more clean look at how real players want to be positioned before they disappear for 8 days. Segment 4. 3 scenarios for tonight's Open. The video lays out 3 clear scenarios with probabilities. Scenario 1. Base case, 60% probability. Gold opens in the 5,030-5,050 range. Silver opens around 78 to 79. Trading is quiet and range-bound. This is the consolidation scenario. Traders are cautious. Nobody wants to put on huge positions right before an 8-day liquidity hole. What it looks like on the tape, gold hovering near 5,000, 5,050. Silver hovering near 79. Light volume, slightly wider spreads, but no aggressive moves. If we see gold holding 5,030, 5,050, silver holding 78 to 79. No major volume spikes in the first hour. That's your sign we're in base case mode, kicking the can down the road into the blackout. Scenario 2, bullish case, 25% probability. We gap higher on follow-through from Friday's CPI rally. Gold jumps to 5,070, 5,100. Silver gaps to 8082. This is the FOMO and front-run scenario. Chinese and Asian buyers who want exposure during the holiday load up tonight and Monday morning because they can't trade for 8 days. Global macro funds that saw the CPI number decide they want more gold and silver before the Fed minutes and before liquidity thins. Key levels to confirm it's real, not just a gap that fills. For gold, 5,070 area was Friday's intraday high zone. A clean break and hold above 5,070, 5,100 on strong volume signals genuine buying. For silver, 79.35 was Friday's high. Pushing through 79.50 and holding it tells you buyers are in control. Also watch. Dollar index staying weak near 97 or breaking toward 96. That's extra fuel. Real yields compressing further below 1.86%. Any weekend geopolitical news, Venezuela, Iran, Taiwan, that could spark safe haven flows. If gold clears 5,070, 5,100 with volume and silver holds 79.50 plus, that's your bullish scenario in motion. Scenario 3, bearish case, 15% probability. We gap down on profit taking and pre-holiday risk reduction. Gold slips to 4,980, 5,000. Silver opens 76, 77. This is the liquidity fear scenario. Traders look at the calendar, remember January 30th's 35% crash, and say, I don't want to be long into a liquidity black hole. They sell into thin Sunday night books, and the gap lower appears. Critical levels. Gold, 5,000 is the line. A break below brings the 4,150, 4,900 support zone into play. Lose that, and you target around 4,050. Silver, 78 is key. A break below puts 76, 77 in play. From there, it's a straight path back to Friday's $74 low if panic shows up. The video still calls this the lowest probability outcome because Friday's close was constructive, near session highs. CPI was genuinely positive for metals. Spec positioning is already washed out. 2-year lows in gold, nearly net short in silver. There just aren't many weak hands left to crush, but liquidity fear can override everything in the short term. Segment 5, what to watch hour by hour tonight. Here's the playbook the video lays out for tonight's session. 5 p.m. Eastern. Many brokers begin showing electronic quotes. This is pre-market pricing, thin, wide spreads. Use it as a hint, not a trade signal. 6 p.m. Eastern COMEX Globex futures officially resume. Real volume starts, real price discovery begins. By 8 p.m. Eastern, we're in full Asian session liquidity, Tokyo, Singapore, Hong Kong active. The crucial window, the first 30 minutes from 6:00 to 6:30 p.m. Interpretation. If we gap and then immediately fill the gap, that's mostly profit taking and position squaring. If we gap and hold the gap for 30 minutes, that signals real directional intent. Volume thresholds. For COMEX gold futures, first hour volume above 20,000 contracts, or strong engagement. Below 10,000, or caution, lack of conviction. Key levels tonight, gold resistance. 5,070, 5,100, 5,150 gold support, 5,030, 5,000, 4,950, silver resistance, 7,950, 80, 82, silver support, 78, 77, 76. Breaks through these levels with volume are your signals. Random pokes that reverse on low volume are not. Segment 6, China's last half day and the 8-day blackout. Now zoom into tomorrow. Monday, February 16th, Lunar New Year's Eve. Shanghai Gold Exchange and Shanghai Stock Exchange will either run a half-day session or be fully closed. Hong Kong, half-day trading. Singapore, half-day trading. This is China's last chance to position before a 7-9-day blackout. What to read from that half-day? If Chinese buyers are aggressive, it says they want exposure to gold and silver during the holiday. That's a bullish signal. They're willing to carry risk through the blackout. If Chinese sellers dominate, it says they're reducing risk ahead of closure. That's a bearish tone setter. By Monday afternoon GMT, liquidity falls off a cliff. From Tuesday, February 17th to Monday, February 23rd, Chinese markets are completely offline. Gold and silver will trade without their largest physical market active. This is what makes the week so dangerous. Wednesday, February 18th, FOMC minutes. Normally important but manageable. In thin liquidity, if minutes show division within the Fed on rate cuts, that could swing gold 2-3% in minutes. Friday, February 20th, Hong Kong fully reopens while China is still closed. This is your first Asian feedback on the week's moves. If Hong Kong validates the move, it likely sticks. If Hong Kong fades or reverses it, that signals the move was mostly thin liquidity noise. And remember, all of this happens while we drift toward February 27th with that 4-5.1 paper to metal ratio still in place. Segment 7, the March 27th squeeze and what hasn't changed. The video calls March 1st notice on the 27th the real event. By then, the setup looks like this. COMEX registered 103 ounces. Potential March delivery claims 500 NMN ounces. Inventory still draining at 785K ounces per day. Lease rates have already spiked near 34.9% in recent stress. Silver is in its 6th consecutive year of supply deficit. China's new silver export restrictions, effective January 1st, still choke refined supply leaving the country. Sovereign mints are quoting 8 to 10 week delivery times. SD bullion just saw 2.5x its all-time record physical demand when paper silver crashed. None of that changed because gold printed 5,040 on Friday. None of it changes if we gap up or down tonight. The fundamentals are the fundamentals. The liquidity crisis is the liquidity crisis. This week simply decides from what price we approach that March delivery showdown. From 5,200 gold or 4,800. From $85 silver or $72 silver. But we are approaching it either way. Segment 8. How to survive the most dangerous week of 2026. The video ends with very blunt guidance. For physical holders, do nothing. This week is noise relative to your long-term thesis. Let Lunar New Year volatility pass. Reassess after Chinese markets reopen around February 24th, with eyes on March 27th. For traders, cut position size by 30 to 50%. Widen stop-loss levels so you don't get wicked out on random gaps. If you hold overnight between Feb 17th to 23rd, understand you are taking liquidity risk that cannot be hedged. Consider using options instead of outright futures so your risk is defined. Take profits at resistance levels instead of swinging for home runs in an illiquid tape. The unresolved tension the video lays out is stark. Gold around 5,040, silver around 78.90, 103 men registered versus 400, 500 meter potential delivery. China shuts for 8 days starting tomorrow. First notice 12 days away. Spec positioning at 2-year lows, while institutions deployed about $19 billion into the sector in January. Retail calling bubble, Wall Street quietly raising gold targets towards 6,300. Tonight's Asian Open won't solve that tension. It will just tell us how the market wants to stand going into the most uncertain week of 2026. So, watch 5,070 and 79.50. Watch the first 30 minutes of volume. Watch how Chinese traders behave in tomorrow's half day. And remember, physical will win. The only question is when and from which price level you chose to live through the move. You've been watching John AG here, and I'm OG John AG. If this helped you see why tonight's Asian Open is just the opening move in a much bigger game running through March 27th, hit like so this kind of real-time breakdown doesn't get buried, and subscribe with all notifications on so you're not trying to interpret this week's chaos alone in the dark.